Hello, dividend growth stock investors. Happy Friday. It is Colby, the DGI Crab, coming at you with the video that I do on the final trading day of every week, where I analyze each of the 60 stocks that this channel focuses on and look to see where the value might lie in each of those positions. Now, I'm not a licensed professional financial advisor, so you should always do your own due diligence before you invest in any security. But what I'm wanting to do is go over my personal strategy and give you some ideas for what you could do for building up your passive income stream, which is what this channel is all about. Dividend growth stock investing in only the best of the best. Markets are trending up this week due to the presidential elections being over, and a lot of the times just having some certainty moving forward with who's going to be in office over the next 4 years can do a lot of positive things for the stock market. Uncertainty is definitely an enemy of the markets. Now, before I jump into the spreadsheet on each of the 4 tiers, just going to really quickly review with you what the DGI Crab allocation strategy is. So the way I break it down is minimum of 50% of new invested money goes into age-appropriate ETFs, so diversification is guaranteed. Stocks that are yielding 30% or more above their 4-year average yield are the ones that I'm looking to add new money to. My top 10 favorite stocks, if they're yielding 20% or more above their 4-year average yield, then I will go ahead and pull the trigger regardless of which tier I happen to be in and add that stock because they're in my top 10. I obviously think they're just that good, and I don't wait for them to go ridiculously on sale. I'll just take a little bit of a discount if I can get it. Now, I remain within my tier unless there happens to be a stock outside of that tier yielding 50% or more above their 4-year average, because to me, that shows massive signs of undervaluation. And then finally, if there are no buyable stocks within my designated tier, then I'm just going to add more money that week into the ETFs. I'm not trying to time the market week to week. I'm trying to add that passive income wherever I can get it. But because single stocks are inherently more risky than ETFs, I am going to wait until I get a deal on the individual single stocks. So, okay, here is the spreadsheet with each of the 4 tiers. This is broken down by your age, the most important metric for a dividend growth stock investor to consider. Tier 1 is for the younger folks, the 18 to 30-year-old investors, where we're trying to acquire kind of lower starting yield in the low to mid 1% range more often than not, but cumulatively we're trying to get a 12% or better annual dividend growth rate on the stocks. We're sorting by the valuation metric here. If we've hit that 30% or higher threshold, it shows up in green. 20 to 29% shows up in yellow, which still isn't a terrible buy, but maybe one that we'd be a little bit more patient on. And then the ones in the red, these are either fairly priced or very overpriced. And I don't add new money to the ones that are in the red outside of dividend reinvestment. I don't sell. I'm a buy and hold investor. And I do keep dividend reinvestment turned on across the board. And that's valuation metric we're getting by comparing the 4-year average yield of the stock to what it's yielding current day. For our tier 1 investors, we've had Nordson in that green zone for a while now, but it has gone up a bit in this hot stock market and has fallen below that 30% threshold. So for now, Nike remains the only stock in the tier 1 category that is in that green buy zone, and it is well above the 50% undervalued mark. So this is one that other tiers could feel free to dip down here and add some more. Nike still yielding nearly 2%. Fantastic buying opportunity if you ask me. Tier 2 for the age 31 to 41-year-old investors, we're getting a little bit higher starting yield here, more in the 2 to 3% range, and we want high single-digit annual dividend growth rate. Hershey and Target are still in that green zone right now. Hershey continues to have a very difficult year, but it's a fantastic stock, wonderful company, and it is one that if you've been keeping track of what I've been doing here for the last few weeks now, I've certainly been confidently adding to that Hershey position. Target remains right there in the buy zone so long as it's staying below $150. it is pretty comfortably in that category to me. Starbucks and McCormick, not terrible deals, but still ones that I'm going to be patient on before adding anything new to. NextEra Energy was one of the few stocks, I talked about this the other day, one of the few stocks that didn't immediately go firing up into the into the stratosphere once the elections were over, but it did recover a little bit today. I was hoping that it might drop some more so I could add that into my buy category as well, but you can't keep a good company down for too long, and NextEra rebounded pretty nicely. Tier 3, age 42 to 53-year-old investors, where we're looking for starting yield more in that 3 to 4% range and mid to high single-digit growth rate. We want to try to get at least 5%, but hopefully more like 7 or 8. Archer Daniels Midland and Hormel Foods remain in the buy category for this age range, both yielding in the high 3%. Archer Daniels Midland a little earlier this week very briefly dipped below $50 a share, which put the yield above 4%. I wish that I had noticed that when it happened. I missed it on that one. But certainly I added to Archer Daniels Midland, that one also in that 50% or more undervalued category. So each of tier 1, 2, and 3 have a stock in that 50% or more undervalued by my metrics. So there's a lot of open season purchasing here that can happen from tier to tier. And in addition to that, Pepsi, which is in my top 10 stock list, has been going slightly above to the 20% undervalued range. About $165 is the sweet spot there, and it dips a little below that, and then it recovers a little, dips below that. I added to Pepsi this particular week, and it just has to hit that 20% mark for me. And I'm jumping all in on that one. Tier 4, we're getting closer, guys. So this is age 54 and up, where we're wanting to get at least 5% starting yield, if not better, and a good solid year-to-year growth rate. We don't want that to be stagnant. If we can get a 2, 3, 4%, that's what we want to do, because with this crowd stops reinvesting dividends, we still want them to get raises to keep up with normal years of inflation. Realty income is getting very interesting again. It's not a slam dunk of a purchase, 16% undervalued, but this 5.5% current yield isn't a terrible deal. Realty income recently reported earnings. I thought that there was more good news than bad in their earnings report from what I could tell. And, it's certainly, because it's a real estate investment trust, should greatly benefit from the Federal Reserve lowering interest rates, which they just did earlier this week. So this could be a good opportunity to purchase a little bit of realty income if you really wanted to get in there and add to that position. You could certainly do a lot worse, but I wouldn't be adding any realty income unless I was already at that stage in life where I was looking to add immediate starting yield, because you're probably only going to get about 2 to 4% in annual dividend increases from realty income. And that's just not going to cut it if you're still in your younger years, because the dividend growth rate will be more advantageous for the younger folks. But if you're up here in your 50s, trying to add immediate income, realty income, keep an eye on it. Keep an eye on it. I would probably still hold off on it for a little while just yet until some of the smoke clears on this, but it's certainly one to watch very closely. This tab I just keep separate for my top 10 stocks. They're not new stocks here. You could find all of these in tiers 1, 2, or 3, but I do keep a totally separate tab for these just so I can keep a very, very close eye on them. And then again, like we saw here, Pepsi is right there at that buy zone. Johnson & Johnson starting to flirt with that a little bit also, but Pepsi's the news on this particular tab. And now we get into the idea of the strategy and the allocations, what that would look like. Now, this is what I would do in each of the tiers. I'm personally in tier 2, so this is what I did do. I've showed that in my video yesterday, but we'll review that here in a little bit. So As I said at the beginning, 50% of new money into ETFs. Let's get the diversification taken care of. And for the younger folks, I think 25% into the S&P 500. You really can't go wrong. 15% into small cap values. So you can get some exposure to the small cap companies and still get a decent dividend out of the deal. 5% into dividend appreciation, and then 5% into international. Tier 2, same idea, same 4 ETFs for me. It's just the allocation's a little different, where 25% goes into the dividend appreciation, 15 S&P 500, 5 small cap, 5 international. Tier 3, 45% of that money is going to go into a higher yielding dividend-focused ETF like VYM, SCHD, or DHS. You could split that out evenly, put it all into one, which if you've got one that's your favorite, but that's probably where that money needs to be going to. Still keeping 5% into the international. And then tier 4, I've added in several new ETFs to get you exposed to some other things that you probably haven't been purchasing up to this point. SPYD will be your stock coverage, 15% there, and then 5 each into high yield bonds, SPHY, PFFA, preferred shares at 5%, 5 into MLPX, 5 into Devo, JEPI, and SPY, so you get some nice monthly income with covered call ETFs. I think these are my 3 personal favorites that are out there right now, and 5% more into international. Then if we're looking at the individual single stocks for that tier 1 group, 30% is still going to go into Nike. You got to put your money into the best deal in your tier, in my opinion. And now we're going to do Pepsi all the way across the board. 10% will go into Pepsi. Don't feel bad about the slightly slower growth rate on that Pepsi stock as opposed to the other ones in tier 1. If you want to start a very modest position in Pepsi, it's a good time to do that. And you can also reach up and do 5% each into Hershey and Archer Daniels Midland, the tier 2 and tier 3 stocks that are 50% or yielding 50% or more above the 4-year average yield. Tier 2, a lot of activity here. And I illustrated this to you yesterday with how I did this in that Fidelity account. 25% to Hershey, 10% to Pepsi, 5% to Target, and then 5 each into ADM and Nike. So we've got the most undervalued stock in the tier 2 in Hershey, the second most in Target. That's 30% of it, right? And then 10 into the top 10er in Pepsi, and then 5 each into the tier 1 and tier 3s that are 50%, yielding 50% or higher. So that's a pretty wide allocation, but that is how you build up a portfolio that has a lot of diversification and is going to pay you passive income from multiple different areas. For the tier 3 folks, they would go 25% ADM, the most undervalued stock in their tier, 10% Hormel, the second most undervalued one, 10% again here into Pepsi, and then I'm probably not going to do Nike in tier 3, but I would dip down and grab Hershey, do a little 5%er into that. And then for the tier 4 folks, this is going to be the same that I've been saying for a while now. Not an individual stock in the tier 4 category that is in that buy zone range. So it's an ETF double down, where instead of 15, 5, 5, 5, 5, it's 30, 10, 10, 10, 10, 10, 10. Going to keep that 5% consistent on the international front and put that extra 5% that's left at that point. I'm going to go Pepsi here also. No sense reaching on something that's not of really high quality. Pepsi is plenty good enough right now. Tier 4 folks, you still every once in a while, it's not a bad idea to add a little bit of something to one of those positions that's going to give you a little bit better overall dividend growth. And then just to recap with you, this is what I showed yesterday as a tier 2 investor. This was what I added. The Hershey position at 25%, the VIG 25, the VOO 15, 10% into Pepsi, and then 5% each into Nike, BBR, VYMI, ADM, Target. So you combine all that stuff together, that was a $2.44 overall dividend income added. And that pretty much rounded out my week. Let me know what you all have been buying, and I will see you on the next one, you guys. Make a plan for the weekend and keep investing next week.